October has been a big down month for the stock market. It's also been a big down market for the fund so far. I won't lie, it's really difficult. It's really difficult because we have well-articulated plans to buy great companies when they're cheap, which they aren't right now, and to short bad companies when they're expensive. And we've done everything right. This month has been an incredibly brutal turnaround, and we are invested in quite a few tech stocks. Tech stocks in particular were probably overvalued this year, and as a result, they're taking the brunt of the decline. The emotions are real, and any hedge fund manager that says otherwise is probably lying. I don't have a crystal ball. I don't know what'll happen, but I do know a few things. There are some facts that we can rely on. The first is that stocks have done very well year to date, at least for our portfolio. And so that's created a cushion for us, and that's great. So as a result of terrific stock picking, we created a margin for safety. The other fact is that the macroeconomic situation is actually pretty good. The Chicago Fed National Activity Index, it's a basket of dozens of macroeconomic indicators, indicate that the economy is doing just fine. So this is probably a correction due to overpricing, overvaluation, but probably not the same as the 2008 situation. That said, it's difficult to stay calm and composed, and it's even more difficult to do the right thing. But at times like this, it's super important to keep your wits about you, to actually do what you're supposed to do, which is to tune out the market, to basically focus on stocks, individual securities, and direct your efforts towards research. That's not easy to do, but that's exactly what we're going to try to do. The problem that the whole industry have is we are deathly afraid of big losses like this. We're deathly afraid of volatility, and it causes us to do the wrong thing. Warren Buffett has it right. He tells us and teaches us that we have to basically ignore the market. We have to understand that the market is there to see whether somebody will do something stupid. And we're not going to do that. We're going to stick to our knitting. We're going to buy great companies when they're cheap. We're going to short bad companies when they're expensive. And we're going to ride out this very volatile situation. Just another quick word or a thought about market volatility. A lot of hedge funds and professional investors equate market volatility with how risky something is. So if the stock market is gyrating up and down, it's really risky compared to something that's just moving in a straight line. Risk is not the same as volatility. Risk should not be defined as volatility. Rather, it should be the probability or the likelihood of permanent loss of capital. What that means is that how risky something is should only depend on how likely it is, or what is the probability that you'll completely lose your money or you'll lose a part of your money in that investment. So, for Lighthaven, as an example, we bought all of our stocks, at cost basis and at prices way lower than today. We had the benefit of the run up, but yeah, even with the current volatility, the fund is still doing fine. And of course, not as good as it was a month ago when the stock market was all-time highs, but still handily outperforming the market. And this is a really critical thing to keep in mind, that market volatility is basically something that you should ignore, and that we're going to ignore, that you should ignore in October 2018. It's noise, and yeah, it hurts. Yeah, everybody is freaked out about it, including institutional investors. But honestly, they should be focused on something they have control over, like the research and whether they're buying stocks at good prices or whether they're shorting stocks at high prices.